Yesterday, we looked at check reconciliation. And on the 4.2 page, you had this checking account reconciliation worksheet. So what I've done is, just to save a little bit of time, I have already gone through and I added all of these transactions down to this check register. All right. So that was the first thing that you were doing as you went through this, is that you just had to move these down into the register. All right. And if you did that all correctly, you added everything up, subtracted everything, right? Remember, we started at 4188. Anytime that we add money through a deposit, we're going to add that amount over here. So 4188 plus 1134.10 got us to that 1175.98. Then we have a bunch of deductions and payments. So each one of these is subtracting out of the amount that we have available to us. So check 121 from 4770 took that 4770 out, taking us down to 1128.28. We wrote a check in Manny's garage for 224.85. We subtract that money out to 903.43, and so on. All right. So all these payment amounts, those are debits. Those are coming out of our balance. Any deposit, okay, is a credit that is adding to our balance. If you went through and you added all of that up correctly, all right, you should have ended with 318.96. And then we get to the end of the month, we've got our bank statement, okay, and it says that we have 343.31. Obviously, those two numbers are not the same. 343.31 is not the same as 318.96. They're in disagreement. We need to get them to agree. We need to make them come together and reconcile that. All right. And so we are going to go through and we're going to compare our records to the bank's records to see what they've received and processed and either added to my account or not added to the account, or not subtracted to the account, and so on, to see where those two things are off. The first paycheck deposit is checked off. Check 121 here for 4770 is checked off. Right. Check 122 for 224.85 is right here, so I can check both of those off. All right. The ATM withdrawal for $20 is on the statement. Okay. An online bill pay to insurance for $214.25 is right here, so I can check that off. That off. Okay. Check 123 for cable for $100.25 is on there. So I'll check that off. All right, check 124 for 58.20 is on there. So I'll check that off. Okay, check 125 for 171.92. Right here. The deposit for 1134.10 is right here. So I can check that off. So the bank received it, processed it, added it to my account. All right. Ready more checks 126 for 317.60 is right here. So I can check that off. Check 127 for 67.90 is on my statement, so I can check that off. All right, online bill pay on the 20th for 65.50 is right here. I'll check that off. Check 128 for $465 for rent on here. Check that off. Check 129 for Nicholas Hardware for 1110 is not on here. You can see the last check that they received and a process of check 128. So check 129 is not on that statement. So I'm not going to check that off. Okay, that's what, if you remember, that's what we call an outstanding transaction, meaning that it hasn't been processed, it's missing, it's not on this statement. All right, so we'll move on to the next one. Cash deposit on the 27th for $80 is right here. Check that off. Check 130 for 1925, again, is not on here. So I cannot check that off because the bank, by the time this statement was printed, the bank had not received and processed that check. All right, debit card purchase for 62.60 is right down here. Yeah, it says a POS debit, so that means the debit card was used at a point of sale. So POS, when we're talking about money, is point of sale, not piece of whatever. All right. And then finally, an automatic withdrawal of $225 for a student loan is right there. So I can check that off. So if I look this over, there are two transactions that the bank hadn't received by the time this statement was printed. Okay. Now, if we look, it says the statement covers everything that they have received through the month of May. Okay, so the 1st through the 31st. All right, these occurred during May, even if they had occurred after May, right? If I was looking at this at June 2nd or June 3rd, right? I would still include those in this process because I want to know how much money I have available to me right now. All right, so there are two checks that they haven't received. So Nicholas Hardware back on the 24th. Okay, so that's a week prior to this. So probably the owner of that business, you know, a small business maybe isn't going to the bank every day. They're making maybe a trip once a week to deposit any checks that they receive. Okay, so they just haven't made it to the bank yet, or they haven't deposited it yet. Same thing with Thrift Mart. Okay, it just hadn't gotten through the bank and processed by the time this was printed. So those are my two outstanding transactions. All right, so I'm going to come over here, check 129 for 1110 is outstanding, and then check 130 for 1925, I believe it was. Yeah, is outstanding. Okay, so overall, that's $30.35 in outstanding withdrawals. I have no outstanding deposits. Okay, during the month there were 3 deposits, and there's a check mark by all 3 of those. So I do not have any outstanding deposits. All right, and now I'm going to complete this portion, okay, to see if everything balances now. So my bank statement balance, again, if I come up here, my bank statement balance says that at the end, at the end of this statement period, I have 343.31. Add any outstanding deposits. Well, again, I don't have any, so that's going to be 0, which keeps me still at 343.31. Now I'm going to subtract my outstanding withdrawals. Okay, in this case, that's that 30.35. And 343.31 plus 0 minus 30.35 brings me down to 312.96. And if everything has gone well, this number, as it said, should match the last entry, the balance in the last entry of my checkbook register. So if I come down to my checkbook register, I look 312.96, 318.96. Shoot. Now that is a POS outcome. Okay, that's not what we want to see. Okay, we would ideally want those to match up. So I need to go back and I need to check my math. I need to look for any errors. I need to look for any transactions maybe that I missed. So I would go through, I'd make sure, did all my transactions get recorded? They did. Okay, trust me on that. I go back, I check all my math. Is my addition and subtraction on each line correct? You can trust me, it is. All right, so the error isn't there. So now let's look at the statement to see if there's anything. And if I look down, I can see that there is one transaction that I did not have recorded in my records, but that the bank does. Okay, so the bank charged me a $6 service charge. So they probably have different requirements. You know, it could be just their basic checking account charges $6, and most accounts have ways that you can get that fee waived. In this case, I didn't qualify for that, so they charged me $6. Now, maybe I just assumed that most months I get it waived, and I just assumed it was going to be waived, so I didn't record it. Maybe I forgot to record it, right? Maybe I didn't know that the bank charges me. They've been charging me every month, right? I don't know. But for whatever reason, okay, I need to include this $6 charge that the bank charged me that I don't have recorded. Now, if I think that that's an error, I can call the bank or I can stop in and say, what's this charge? Can we get it reversed, right? If there was a transaction on here that I didn't authorize, there's a debit card purchase that I didn't make or an online purchase that I didn't make, right? I call up the bank, I stop in the bank and I say, I need to dispute this charge. I didn't authorize this, okay? This was a fraudulent transaction, whatever the case is. In this case, let's say that it's legitimate, okay? The service fee is a legitimate charge, you know, a fee that I should have expected or whatever, right? If I forget to record it or I just didn't have it recorded, right? What do I do? Well, I need to make sure I record it. So I need to add this here. So what was the service charge of $6? So then 318.96 minus the $6 that's coming out is 312.96. I obviously know that it's on my statement because that's where I learned about it. So I can check that off. I can check this off. Okay, now every transaction that's on the statement is accounted for. I've got that new charge on there, gets me down to 312.96. And now those match. So now I've reconciled. Okay, so I know that I currently have $312.96 available to me to spend or to access or whatever. Okay, so I've made those match. Remember, if those numbers don't match, you are not done in this process. You need to go back and find the error. It could be that you forgot to record something, such as the service charge. It could be that there is a mistake on the bank side of it, and you need to dispute that. It could be that somebody has gained access to your account or your money. You need to dispute that. Okay, so it's not a trivial thing if those don't match. Okay, it's not something where you just say, the heck with it, whatever. I'm sure it's close enough, right? A lot of times, thieves that can gain access to your account information and can gain access to spending your money might do a small $2, $3, $4 charge to see how closely you look at your account, to see how closely that you're checking in to make sure that it's accurate, right? If they make a $5 purchase and you don't notice, okay, and you don't dispute that, kind of gives them a clue. All right, well, they didn't notice the $5 charge. Now I'm going to make a $500 charge because they're not looking at their account closely. And by the time that they catch that, I'm out of here. I've got my $500 worth of goods. Peace out, right? So again, if those numbers don't match, okay, you need to continue the process. You need to go back and find that out. Like I said, after you do this a few months and you start to get the hang of it, or you start practicing with money a little bit more, I think I mentioned I did that, religiously when I first got a checking account. That was before online banking, right? Now I do just a quick check every 2, 3, 4 days. So rather than going through, a list of 30 transactions, I might check in on the 9th and do, since the 3rd, I would have 4 transactions or 6 transactions or whatever. Then a few days later, maybe on the 12th, I check in. Well, in that case, I would have had only 1 more transaction. Maybe I wait until the 15th, right? I've got a couple of more. And so, every few days, I just log in and I look at the new, transactions that my bank has processed. I look at, my budget and look to see the transactions that I've made. And I can do just a very quick, 2-minute reconciliation versus spending, 20 or 30 minutes this way doing it. So the time frame is about the same, probably, 30 minutes once a week or 2 minutes, 10 to 15 times a month, right? It's going to be the same amount of time. But if I check it more regularly, right, it just helps me reduce my anxiety about how much money I have in my account, how much I have available to me, helps me catch any fraudulent activity much, much quicker. Okay, let's say that somebody had gained access to this person's account on like the 5th, right? Well, if they waited until the end of the month to do this, they've waited 25, plus days to find that transaction that they didn't authorize. All right, versus if you're checking every 2 or 3 days, right? At most, you're finding that fraudulent charge, that unauthorized charge, within a couple of days. So I always think it's a good idea to do it as frequently as you feel comfortable, but certainly at least once a month. When you get your final statement. All right. So moving on from that. Okay. So we've done checking account, we've done reconciling. The last thing on here for 4.2 is looking at the different types of short-term accounts that banks and credit unions and so on offer. Okay. And so these are called short-term savings tools. Included in this is a checking account, right? Checking account isn't what we typically think of as a savings account, but it does keep our money safe and it can grow with some levels of interest. Okay. So even though it allows us to withdraw the money as much as we would like and allows us check writing features and access it through debit card, okay, it still is, in a sense, a savings account. Okay. And so this presentation walks through 4 types of accounts that we put our money in, keep our money safe. They're considered short-term just because they're not long-term, right? These aren't accounts that are typically being used to save for, a child's college education or to save for retirement, right? There are certain types of savings accounts that are designed for those long-term goals, like college, like retirement, like whatever, right? So those are different types of accounts. We'll talk about some of those when we get into Unit 7 on like investment and long-term financial goals. These are types of accounts that give you access to money in a much shorter time frame, either immediately, like checking accounts, or even still within a few years, like a certificate of deposit. All right. So it's going to go through savings tools. Okay. Like I said, there are 4 different types of accounts here that it walks through: checking account, savings account. We've already dealt with those to some extent. 2 new accounts that we haven't introduced yet: money market accounts and CDs. It's going to look at those. The biggest difference between all 4 of these is the level of interest that you receive and the level of liquidity. Okay. Now, the first goal of all of these is to keep your money secure and safe. And we've talked about deposit insurance before. FDIC, NCUA, those are government agencies, government institutions that insure deposits up to $250,000 per account per account holder. Okay, so we've talked about that. All 4 of these types of accounts are secure in that they're insured up to 250,000. All right, but they all give us some level of liquidity. Now, when we're talking about liquidity, okay, liquidity essentially just means how easy is it to turn that asset, that valuable asset, into cash. Okay, so if I put money into a checking account, that is very liquid. Okay, so cash is pure liquid. Okay, cash is the most liquid. That's why we when we talk about like cash flow, we talk about money coming in and money going out, right? Almost like a river, or like flowing water. Okay, it's coming in, it's going out. So cash is liquid because I can spend it, I can say I can do whatever I want with it at any time. Checking accounts are the most liquid because they're very close to cash. They're not quite cash. Okay, but I can write a check and get that money out anytime I want. I can use a debit card at a point of sale or at an ATM and get it into cash in my hand with relative ease. All right, so those are very liquid in that it's easy to convert that into cash quickly. To the other extreme, a CD is much less liquid. Okay, a CD kind of locks your money into place for the life of that CD, for that life of that certificate. So it could be 6 months, it could be a year, it could be 2 years, whatever. Generally, during the life of that CD, okay, you can't access the money. So it's illiquid. Okay, liquidity doesn't just apply to types of accounts. Okay, anything of value, any asset has some level of liquidity, right? My house has some level of liquidity, is very illiquid, but eventually I could turn that into cash, right? It just takes a long time and it's a long process. I need to have it appraised to assess the value. I need to get it on the market. I need to find a buyer. They need to be approved for a loan. The terms need to work out and so on. If I decide to sell my house, it could be weeks or months before I actually see that money. Okay, so that process is a very illiquid process. Okay, that asset is very illiquid because it takes a long time to convert it into cash. Versus if I have money in a savings account and I go to the bank and I say I need to withdraw this money, or I go online banking and I transfer it from savings to checking, and then I use my debit card at an ATM and withdraw that cash. That's a pretty quick process to turn it into cash. All right. So liquidity just refers to how easy it is to actually turn the value of that thing into money in my hands. All right. So as you go through this, that's one of the primary differences between these 4 types of accounts. The other is the amount of interest that you can earn. All right. If I can't access that money into cash, there better be some trade out. There better be some benefit to me. Okay. And so that benefit in most cases is the level of interest that you receive. All right. So what I'd like you to do is go through this presentation on the short-term savings tools, okay, on those 4 types of accounts. All right. And then you've got just one quick little worksheet. It's this 4.2, which savings tool should we use? Show you what this looks like. Okay. There are 6 different scenarios. What you need to do is read through each scenario and describe which type of savings tool, or maybe multiple types of savings tools, right? We're talking about the accounts, would be best for this individual or for this family or whatever. All right. In some cases, it might just be one type of account, one type of savings tool. In some cases, they might want multiple. All right. So you need to identify what would be the best for them. And then, as it says here, be sure to provide a justification. So give a rationale, give a reason why that would be their best option to put their money in. All right. And that's it. As always, then save it as a PDF, upload it to Schoology. Once you get through that presentation and that worksheet, you are good to go.